We have a small gap down below a bull channel, testing the low from a couple of days ago. Yesterday I said that I was concerned that this bottom was not quite at the zone where bulls bought the day before, and now we're at that level. So we'll see if the bulls buy it again here. I talked also about the daily chart having an IOI setup. Yesterday was an inside day. The day before was an outside day. So we have an IOI pattern. It's a breakout mode pattern. And it's better if a market is overbought or oversold. This is overbought. We have a parabolic wedge, 1, 2, 3, or 1, 2, 3, or 1, 2, 3. And we're also above a prior high in a bull channel, and the market typically pulls back below breakout points. We've had breakouts sideways to down, breakouts sideways to down, breakouts probably sideways to down. However, even though it's a sell signal, we have 4 dojis. That makes a breakout less likely, and it makes it more likely there are buyers below yesterday's low. And, yesterday had a fairly big tail on the bottom, so that's not a particularly good sell signal. And this bull channel is very tight, and that makes a reversal into a bear trend less likely. More likely, we'll be doing this for another week or two. I am holding puts and put spreads from a couple of days ago, simply because sometimes when you have buy climaxes, especially at an all-time high, you do reverse from a very tight channel. And just in case that happens, I wanted to have a short position. I think it's more likely that we'll go sideways more. We may get one more new high like this. We had one more new high here. Sideways, we had a couple more new highs here. And I think we'll probably get one more new high before we pull back. Today's a Friday, and therefore weekly support and resistance are important. And last week's high is support. This week's high, low, and open are important. We have a very small week, so we're close to the high, low, and open of the week. And this week may end up looking like this. It may end up being a little doji bar, bad follow through after this breakout. Monthly chart, 11 months without a pullback. And right now we're at the high of the month, but last month closed in the middle, and several months close around the middle. And I suspect that this month, when it closes, will close closer to the middle than it is right now. All right, so what do you do? Okay, we're in the buy zone. Yesterday we just reached the top of it, and now we're at the bottom of it. 2 legs down, 1 pullback, 2. Whenever the market's sideways, it often has a lot of 2-legged moves. Sometimes they subdivide. To me, this is a buy zone. Head and shoulders top, but head and shoulders top is a trading range, usually a triangle, and now we're near the bottom. Traders are paying attention to the tail on top. If the bar closes on its high, then maybe 25-30% chance we've seen the low of the day. If it has a 2 or 3 tick tail on top, then maybe only a 20% chance it'll be the low of the day, and it would increase the chances of sellers above. We gapped below yesterday's low and immediately closed the gap. So that's bad for the bears. Here we gapped above yesterday's high and immediately closed the gap. Bad for the bulls. We're getting a failed breakout below a bull channel. Risk, bulls buying above 1. Risk is to below the bottom of 1. Can you sell the 1 high? That's the one thing I would not do. Right? You can argue that we've been in a bear trend for several days. We've been getting lower highs and, possibly a lower low today, right? But we're at the bottom of a trading range where the market has been reversing up, and therefore when you get a good bull bar like this, I would not sell the high of the bar. So I think you either buy the high of the bar with a stop below 1, or you wait to see if we get consecutive strong bull bars that would increase the probability that we have seen the low of the day. Suppose 2 is a bear bar. Do you sell below it? A pullback from the break below yesterday's low and a pullback from the break below the bottom of the bear channel up there. I don't know. I would not. We're too low in a tight trading range. Here's the daily chart. We have 4 dojis and right at the bottom of that developing range. Disappointing entry bar for the bulls. Still more likely that we're going to go up. We close the gap and we have a good looking bull bar on bar 1. What do the bulls do? If they bought, I think their stop is still below 1. And for the bears, I would not sell below 2. I still think we'll probably go up. Suppose we trade below 1, it probably then will be like yesterday, trading below 6. Probably buyers below. We're in a buy zone. The bulls bought aggressively here 2 days ago. Who's going to go short below 1 or 2? I would not. I did not buy above 1, but I think it's okay to be long here. Micro double bottom, gap down on 1 and then up on 1, down on 2, up on 2. I think always in the long, but I'm not particularly bullish. I want to see more information. Right from the open, we have a good bull bar and then terrible follow through. So confusing increases the chances that today we'll have a lot of trading range price action like every day for the past 2 weeks. Reduces the chances that today will be a strong trend day. We gapped down, we rallied, we sold off on 2, we're trying to rally again. The location is good for the bulls. We're at the bottom of a 5-day tight range, but a bad entry bar, bar 2. Yesterday we needed to go sideways for several bars before we rallied. Wednesday we needed to go sideways 5 bars before we rallied. And that I think is is part of the reason why I did not buy, even though I think we're always in long. This is a second entry buy. I went above 1, sold off, even though 2 did not fall below 1. So buying here is a higher probability buy than buying above 1, but the bulls need to get a pretty good bull bar. Otherwise it becomes a micro double top, up on 1, down on 2, up on 3, and then it would be a micro double top, a low 2 short. If you want, you can call it a low 1. On this time frame, it's a low 1. On a smaller time frame, it'll be a low 2, but it would be a failed breakout back above yesterday's low. More likely, bottom of a 5-day trading range, we're going to go up. This is the past week trading range, and we're near the bottom, so more likely we'll go up than down. I've said the open of the week is an important price, so I'll put a line. I'll wait a moment. Anyway, for the bears, this is a breakout pullback sell, but a doji bar, not a strong sell. And the location is good for the bulls, and the buy signal bar is good for the bulls. So I still think the market is always in long. This is the open of the week, above 2,500. And if we're within 4 or 5 points of that in the final hour, we may get drawn up to it, especially since it's also at the 2,500 big round number. Best choice, flat. Second best choice, long. And third best choice is short. I would not be short, even though this is a pullback from the breakout below yesterday's low. It's a bad sell signal bar. 2, we're not at the moving average, and we reversed up from below yesterday's low, and we're at a price where the market has reversed up repeatedly on Wednesday, and we've been reversing up or anytime we get low over the past week. What do I need to sell? I would like to see a couple big bear bars closing on their lows, or the market going sideways to the moving average. And a second entry buy. This would be a higher probability buy, like on Wednesday. First entry buy, and then a second entry buy. But a lot of bulls will only buy above 4 if it's a bull body, and they probably want at least a 2 or a 3 tick bull body. If they do get a good buy signal bar, then it would be like Wednesday. Bull bar, good buy signal bar. Yesterday, 2 good buy signal bars. Got a reversal, got a reversal. Without a good buy signal bar, I think most traders will probably wait. Is it high enough probability for a scalp? I don't think so. It's forcing traders to buy high in a tight trading range, so the risk is big, and we've had multiple reversals, gap down, rally, down, up, down, right? So the probability is not as high as scalpers need for that amount of risk. However, I still think the market's always in long. Also, only a 1 tick bull body, 2 tick tail. It increases the chances that we're going to probably go mostly sideways here. Can today still be a trend day? The odds are against it. We're getting reversals on every bar, and we're in a tight trading range. What's good for the bulls? We're triggering a sell signal on the daily chart. We're getting a break below a bear ILI. What's good for the bulls? We're at the bottom of a 5-day trading range. So right now, not much to do. By trading down again on 5 after getting the reversal on 4, that slightly increases the probability for the bulls buying above 4. But you're buying up at the top of a tight range. Stop order bulls above 1 have not made money. Stop order bulls below 3 have not made money. Limit order bears above 1 and 2 made money. Limit order bulls below 3 made money. So it's a limit order open, breakout mode. Location, good for the bulls. And then the sell signal on the daily chart, good for the bears. You know, you have to bet the bulls, you have to bet that we're always in long. We're trying to reverse up from below yesterday's low. If 5 closes on its high, at the 4 high, in other words, with a 2 tick bull body, that would be a higher probability stop entry. That would be the highest probability stop entry of the day. If it closes on its low, is a sell? I still would not sell. We're at the bottom of a 5-day range, and there's no strong momentum down yet. If I'm going to be selling, at the bottom of a tight trading range, I want there to be a lot of momentum down, and we do not have that. So we're in the buy zone, and the bulls are trying to create a credible buy setup. Probably mostly a trading range day today, just like the past 4 days. Everyone sees what's going on. Will 5 close on its high and create a decent buy signal? Look at that, right? If the bulls are so good, why could they not get 5 to close on its high? So something's wrong with the bulls. Yes, they have great location, and yes, they keep reversing up, but why are they unable to create very credible buy signals? And the answer is because they're not strong enough to do it. And it reduces the chances that this is going to be a strong bull trend day. And the bears, they gapped down below yesterday's low, but the gap was small and it closed immediately. So the bears are not as strong as they need to be either. So right now, traders are waiting either for an upside breakout that reverses down, a downside breakout, or a downside breakout that reverses up. For a trend, if you think about it from a trend perspective, it's never critical to enter early, because if it's going to trend up, it'll become clearly bullish, and then you can enter and have a high probability of buying. So usually traders who are really eager to enter early because they're afraid of risk are traders who do not believe it's strongly trending. Again, if we get a bull bar closing in its high, okay buy for a swing up. As for shorting, we're shorting at the bottom of a 5-day range. I would not take the short. I would wait to see if we break strongly to the downside, even if we get a bear inside bar on 6. Right now we have an II. If this ends up as an II, if 6 is another inside bar and it closes on its high, reasonable buy signal. And let's say it closes on its low, I would not take the short, simply because we're at the bottom of a 5-day range. I would wait for the breakout. Breakout mode, good sell signal bar, bad location. I would not take the sell. And for the bulls, the location is good, but the buy signal bar is not. I still think we're always in long, so I would either be long or flat. Will the bulls get out below 6, a low 2, in a bear trend? Well, their stop is still probably below 1, but I think it probably is okay to get out below 6. Again, I'm flat. I want more information. In other words, I want higher probability. Can you simply buy right here and put a stop below 6? I think the logic is good, right? A very good sell signal bar 6, a low 2 short. If the bulls are able to prevent the market from triggering that short, then we're probably going higher. So therefore, you're buying here, you're risking 3 or 4 ticks to make 4 points or more. And I bet you have at least a 30% chance that we will go up here without falling below 6. Six is actually a reasonable buy the close bar because the bulls will get out below 6 and therefore they will buy the close of 6 and 1 or 2 ticks above the 6 low, trying to prevent the market from falling below 6. They do not want the market to force them out. A lot of bulls will get out below 6. It's still a second entry buy above 4, a bull bar, and above 7 as well. The odds are, I'm saying we're always in long. I think the odds are we're going to try to go up, but I'm still thinking that today is not going to be strongly bullish. Look at yesterday and then look at today. We have that magnet at the open of the week and 2,500. So we may have to get up there. We're not that far from it. All right, the bulls had a terrible entry bar on bar 2. Now they're getting a second entry buy. Let's see if they can get a better entry bar here. Will bears scale into shorts above 3? I would not. Will they sell at the moving average? They're always going to sell at the moving average when there's a gap down, but I would not. Important bar, the bears want a low 2 with bar 3, and the bulls want a breakout and a measured move up. They want to get back up to a cluster of magnets. Yesterday's close, open of the week, 60-minute moving average. This is another one of those examples of a second failed breakout, yesterday's low. Broke below yesterday's low, reversed up on 1. The bears broke again to the downside on 4, and we're reversing up a second time. Sometimes the market, even if it goes higher, sometimes the market goes sideways after triggering the second entry buy. For the bears, low 2 short below 8, but unless it's a pretty strong bear bar, most traders will not sell. Can the bulls get out below 8? Well, I think it's probably okay if they get out below 8. You lose 2 or 3 ticks. Because if it is going up, we should go up. We should not immediately reverse down. But technically, the stop is still probably below 6 or below 4. The bulls who bought above 1 still have not made money. Here we are 8 bars into the day, and at the time of day when the market typically has pretty quick moves. And, in 8 bars, the bulls have not even made 1 point. So it increases the chances that today is going to be mostly another trading range day. Low 2 short, but buyers or sellers below 8. I suspect probably buyers below. I think we're always in long, but very weak attempt by the bulls. Can you sell below 8? I would not. Yes, you could. It's a pullback to the moving average and what could be a big bear trend day, but I would rather be shorting below bear bars, not below bull bars, at least not until it's clearly strongly bearish. If it becomes strongly bearish, then traders can sell below any kind of a bar, bull bar, bear bar, doji bar. Wednesday, second entry buy, very strong reversal up. Yesterday, second entry buy, okay reversal up, but not as strong as this. Today, a second entry buy, very weak reversal up. Bulls are getting weaker. Let's say it has a two-tick bear body closing on its low. Not a good short, but I think a lot of the bulls might get out, even though we're more likely channeling up. So I think we're always in long, and I think we're going higher. Best stop for the bulls probably below 6, a bear bar closing on its low. Not good follow through for the bulls. So a lot of the bulls will give up below 9, even though there probably are buyers below 9. A bad sell signal, so probably buyers below 9. But this is, I think, not good. Here we are, 9 bars after the buy signal above 1, and then there's a second signal above 7, and the bulls have not been able to make 1 point. A lot of the bulls will get out below 9 or 2 ticks below 9. The bear is hoping for a wedge bear flag at the moving average. Yesterday we had that wedge lower high. And the bulls are trying to get above the moving average and then up to the next resistance level up here. Yesterday's close, open of the week, 60-minute moving average. Bulls again able to stop the bears from getting below a bear bar, bar 9. Because this labored so much, a lot of the bulls probably will take partial profits at 1 point. Bears have a wedge, and therefore a lot of the bulls will give up and get out below 11, especially if it has a bear body. Will the bears short if we get, whether or not we get a bear bar? Will the bears short a wedge opening reversal down from the moving average? 5-tick trap for the bulls above 1. I don't know. I think a lot of the bulls will get out below 11 because of the wedge opening reversal down from the moving average. But we have a small pullback bull trend since the 4 low. About 8 bars without a pullback. And I think the bears would want a pretty good sell signal bar to go short. Okay. I think not good enough to go short. As for bulls exiting here, I don't know. I think they could put a stop below 9, a bear bar, if they want to try to swing up. The correct stop is still below 7, but this is really not behaving like a trend. It's behaving more like a trading range. And when that's the case, I usually don't want to use a stop that's too wide, because I don't want to be selling at the bottom of a range, even if it's to sell out of longs. If it's going to be a trading range, I want to be selling near the top, whether to go short or to sell out of longs. Not a good sell, not a good buy. I am back to flat. I talked myself into buying 7 as it was reversing up, and I bought it higher than I wanted, but I still ended up buying below the close of 7. My logic was what I said, that it probably was 6 was probably a buy the close bar. And then when we started to reverse up, that was telling me that the bulls were able to prevent the bears from getting a decent sell. And we probably were going higher. But right now I'm back to flat. I think we're still always in long, but the rally is just too weak. 10 bars to make 1 point in an always in long market in the first hour. That is unusual. So it makes me think that we're probably going to go sideways here. 12, the close of the hour. 60-minute bar, a good buy signal bar. Bottom of a 5-day tight trading range. Breakout test of this tight trading range. So, okay, buy on the 60-minute chart, but tight trading range lowers the probability of everything. More likely, we're going to go sideways more than up, even though we have a good buy signal bar. It's still always in long, and by the close of bar 7, there's a 50% chance we've seen either the high or low of the day. We're now on bar 13, so it's probably a higher than 50% chance that we've seen either the high or low of the day. Right now, it's slightly more likely that we've seen the low of the day, but until we get a very strong bull breakout, the probability is not as high as you might think. We're always in long, but the bulls need a breakout. We have a wedge bear flag at the moving average. Bulls want to get a bull breakout above the wedge and then a move up to the next resistance level up here. I did not buy again. I'm flat, even though I think it's okay to be long. We had a second entry buy above 7. The bears are trying to create a second entry sell below 14. It would be a higher probability sell than below 11 because this is a second entry, but they need to get a bear body at a minimum. If they do get a bear body, I think most bulls will exit below 14. Not high enough probability for the bears to scalp. So I'm personally not going to sell. Right now I'm flat. We have a sell signal on the daily chart. We have a buy signal on the 5-minute chart. And the first hour is a buy signal bar on the 60-minute chart. But we do not have a strong breakout. 8, a breakout, but small bar and terrible follow through. The market's trying to get up to those magnets. Bears trying to get a second entry short with a decent sell signal bar. For the bears, a wedge, reverse down, trying to reverse down. On a smaller time frame chart, maybe a 1-minute chart, this is an expanding triangle. 5-minute chart, I would just call it a wedge opening reversal down from the moving average. But so many small sideways bars that the math is just really bad here. You know, we took almost an hour to make 1 point on a reasonable buy. The reason I exited with 1 point is that my premise was we were getting an opening reversal up from below yesterday's low. My premise was that we were in the start of a swing up bull trend, and this started to look much more like a potential bear flag at the moving average instead of a bull trend. So my premise changed. Still always in long, but I'm not willing to be holding here. This so far is a bull leg in a trading range, and I don't want to be buying too high up. It's still obviously a bull channel. We're getting higher highs, we're getting higher lows, but it's also an 8-bar tight trading range just below the moving average, and we keep selling off at the moving average. 1, 2, 3, 4, 5. When I say always in long, what I'm saying is it's still slightly more likely that we're going to go up than it is that we're going to go down. But it's not likely enough for me to be holding long. Are we always in short yet? Well, you know, we've had, 8 bars since a bull body on 11. Not a good sell, despite a second entry sell below 14. And we're at the bottom of a trading range. Just like I said, it looked like a trading range, and therefore I don't want to be long. You know, being long is the same as buying, right? It doesn't matter if I buy here or if I buy here. At this moment, it's the same thing. If I'm long, it's just the same as me being flat and going ahead and buying. I don't want to buy high. I don't want to be holding long high in what is probably a trading range. The opposite is true here. The bulls will try to get a double bottom around the 7 low, probably around the 4 low. And the bears have to decide, is this strong enough to sell? Is this strong enough to hold short? I don't know. We're probably always in short, you know, simply because of the number of bear bars, you know, since bar 10. So this is now 8 bars without a bull body. But the sell-off right now, not a good sell signal below 11 or below 14. Below 15, it's a bear bar, so it's a better sell, but weak follow through 17. So always in short, but right now I am trapped out. Remember, on the daily chart, we triggered a sell by going below yesterday's low. We have a bear bar, inside bar, after an outside bar, so it's an IOI, but a big tail and 4 dojis, not a high probability sell. Weekly chart, trying to get a reversal after breaking out to a new high and breaking out above 2,500. As you know, I am short, but this is up so strongly over the past 5 weeks. I think we may have to go sideways for a few weeks before we go down. September, October, August, September, October, you know, it's a bad time of the year. Just like, you know, March and April is historically the strongest time of the year. This is the weakest time of the year. So even with a very strong rally on the daily chart, there's an increased risk of a sell-off. Sell the close, but at support at the bottom of a trading range. So I'm stuck on the sidelines. double bottom 7, double bottom 4, but too many bear bars, so low probability to buy the first reversal up. We're in the buy zone, but I think a lot of bulls wanted to go sideways for a few bars before buying too many bars down. You got 4 bear bars and 8 bars without a bull body. Probably sellers above 19, even if it has a bull body, but probably not much more down. A trading range is still more likely than a trend. This is a little bit like this. The market clearly always been bearish, but then you get a couple of bull bars, probably sellers above. Globex chart, a triangle. 1, 2, 3. So what do you do here? Well, the sell the closed bears, if they sell the 18 close, which I would not, I think get out 4 ticks above the prior bar. So they'd get out 4 ticks above 18. Some would say, okay, it's like yesterday. Sell the close bar 5, strong bull bar 6, probably sellers above 6. Therefore, we can sell more 1 point above the 5 close and try to sell more 2 points above, no fill, betting that the first reversal up will be minor and that the bears could avoid a loss. And the same is probably true here as well. Probably sellers above 18. The sell the closed bears will probably sell more 1 point higher, maybe even 2 points higher. And for the bulls to buy this, they need either the market to go sideways and get a second entry buy, or they need to get 3 or 4 consecutive bull bars and have the market come all the way back up here. And they would want the bars to be very strong, because if the bars are weak like this, then the rally is a bull leg in a trading range, and the bulls will not buy. They do not want to buy high, and the bears do not want to sell low. Always in short, but the bottom of a trading range and the momentum down is not very good. So better to sell rallies than to sell closes. And the bulls, bottom of a trading range, but 4 consecutive bear bars, the bulls want a second entry buy. So best choice right now, flat. Second best choice, short, stop above 15. Now, this is bar 19. By the close of bar 18, 90% chance we've seen either the high or low of the day. So at this moment, there's a 90% chance either 1 is the low or 15 is the high. A lot of times when you have basically a trading range day like today, and you have bar 18, and bar 18 is near the bottom, bulls will look to buy a reversal up. There's enough momentum down, I think most bulls want a second entry buy. And the reason why they would buy the reversal up from just above below the day, they know there's a 90% chance we've seen either the high or low of the day. And if the bears are failing to make a new low and the bulls are getting a reversal, then traders will bet we'll get a new high of the day. But I need it to go sideways for another couple bars before taking a buy. How many bull bars do the bulls need to convince traders that they've taken control? They need more than this. Sometimes you have a trend, a bear trend day, where the market rallies to the moving average and sells off a little bit, rallies to the moving average again, and then sells off a little bit. And sometimes it has to happen 2 or 3 times before traders believe that it's going to be a big bear trend. Like this, looks like a bull flag, rallying to the moving average, sells off, rallies to the moving average, sells off, rallies to the moving average, sells off, moving average, sells off, moving average, sells off. And, we don't yet know if today's going to do that. But right now, I think traders more likely are going to be selling here above 18 and at the moving average. A lot of bears did not sell because they wanted to sell at an average price, not a below average price. Bulls trying to get a second entry buy. We've had several over the past couple of days. Second entry buy, 1, 2, second entry buy, 1, 2, second entry buy, 1, 2. But smaller bars, so probably not as strong as this. And this only rallied for 1 point. So I still am not going to buy above 22, but if we get a low 2 short at the moving average, especially with the bear sell signal bar, I probably will sell it, even though we're at the bottom of a trading range. Well, that's a micro double top, so it's a low 2, but not quite at the moving average, and still at the support of the bottom of the range. Bulls trying to get a wedge bottom, bears trying to get the breakout, and a measured move down. Always in short. Stop for the bears now, possibly as tight as above 23, if this is going to be a successful breakout. It should not get back above the 23 high. Technically, the stop is still above 15, but if you're scalping, I think you get out above 23 or above 24. I'm not sure the math is worth scalping a short at the bottom of a trading range day. So I think you're swing trading or waiting. So what do? Double bottom 4. You can call it a high 3. You can go to small wedge bottom, a failed breakout below a small double bottom. But I still think we're always in short, and there's not a lot of room between the 24 high and the moving average. So I would not buy. If it ends up as a surprisingly strong bull bar, 3-tick body closing on its high, maybe I'll buy. But right now, I'm flat. Bears trying to get the breakout below 1, right? They see the day as a trading range day, about half the size of an average day. The market's in breakout mode. They're looking for the range to double. It can double by breaking below the low of 1, falling for a measured move. It can double by breaking above the high of the day and rallying for a measured move. It can double by breaking below 1 and going down a point or 2, and then going above the high of the day and rallying for a point or 2. Not strong trending price action. This is trading range price action, and we're at the bottom of the range. Not a good buy signal bar, but not enough momentum, I think, for the bears to be selling down here. They want to see the strong breakout. Bar 24 at the close of the second hour. The first hour closed on its high, second hour closed on its low. Here it is on the 60-minute chart, but not a good looking sell. We're still at the bottom of a tight range. Plus we had a pretty good bull bar on bar 1. So it makes traders hesitant to sell below a bear bar here, plus again, bottom of a range. So best choice, flat. Second best choice, short. Stop maybe above 15. I don't know. I would not. I'm currently flat, and I want to see a better buy signal for me to buy. Bad location to buy above a bull bar 25, right below the moving average, plus big tail on the top of 25. And for the bears, they just don't have much momentum down, and traders are hesitant to short. Nobody's making money. Limit order bulls are below 19 have not yet made money. Limit order bears who sold above 22 were able to make a 1-point scalp. For the bulls, they're hoping this is a bull flag, like this. Rally, pullback, bull flag. We got a bear breakout. Unless we fall reasonably far below the magnets, there's probably a 50-50 chance we're going to get back up to the open of the week before the end of the day. Obviously, the bulls have to break above the moving average and then above the high of the day. But if the bears are unable to make this sell off, the odds will go up that we'll get up to the open of the week and convert it from its current bear sell signal bar to a more neutral bar, a doji bar. Today's Friday, so I always pay attention to weekly support and resistance. Bull bar closing on its high, which is good for the bulls. The location is good for the bulls. We're trying to reverse up from the bottom of the day. Remember, 18 bar range by the close of 18, 90% chance either 1 will remain the low of the day or 15 will remain the high of the day. And therefore, you have bulls buying here, putting a stop either below the double bottom 424 or below the low of the day. Not yet high probability. Higher probability if the bulls get a reversal up, which is what they're trying to do here. Trying to get back to always in long. Typically in a trading range day like this, the legs are 2 to 3 hours. We went up 1 hour, down 1 hour. So chances are either this rally is part of a 2 to 3 hour sell-off, or it's the start of a 2 to 3 hour rally. I'm going to turn the screen off for a second. I have to check something. Bears, they'll sell the moving average, they'll sell the 20 lower high, but 3 consecutive bull bars, I would wait. The bulls probably need 1 more bar. And in trading range days, by the time you think it's always in short, like bar 17 or 18, you're probably at the end of a move. By the time you think it's always in long, let's say we get 1 more bull bar, then you're probably near the end of the rally. You're probably near the top of the range. That's always the case in trading range days. The bears, as I said, want this to continue to sell off like this. Strong bull bar, sell off. Strong bull bar. A pair of strong bull bars, sell off. Here's a 2-day range. 2 strong bull bars, sell off. Several strong bull bars could not go up, eventually sold off. A lot of bull bars sold off. Bull bar, 2 bull bars sold off. 3 bull bars sold off. So the bears are hoping that today would be like that. Too early to tell. I still think the open of the week is an important magnet. And I still think there's a 50-50 chance we're going to get there before the end of the day, and that the weekly chart, instead of having a bear bar closing on its low, it'll have a bar that closes more around the middle, like these bars. Okay, swing long. Okay, swing short. I think most traders are better off waiting for more information. Bulls trying to get their breakout. Markets in breakout mode. Trying to reverse up from the low of the day and the bottom of the 5-day range. Location, I think, is good for the bulls. Not a good signal bar, 24, but 26 closed on its high. So that is a better buy signal bar. But traders are hesitant to buy too high on a day where the range is so small. Will this accelerate up and get quickly drawn up to the magnets above? I don't know. We have a lot of hours left in the day. We have 4 hours left in the day to get there, and we're only 3 points away. I think 50-50 chance we get there. Every bull bar that we get increases the chances. Yesterday we had a wedge bear flag here. Today we have a wedge bear flag here. The bears are trying to get a wedge bear flag here. the bulls probably need one more bar to convince traders it's always in long and that we've seen the low of the day. Without it, the bears will try to get their wedge and then a breakout to a new low. Are we always in long yet? Might be. If we get a close here, then we have a breakout on 30, even though 31 pulled back one tick below 28. But if we close right here, I think we're probably always in long. And I think then better than 50-50 chance we'll get the new high of the day. So in other words, better than 50-50 chance we'll get back up to the open of the week. Suppose we have a one tick bull body. Well, I still think we would be always in long. If we have a bear body, then, I don't know, it'd be more neutral. What are the chances of this accelerating upward and becoming a big bull trend day? Maybe 30%. 70% chance it's going to be a quiet day, trading range day for the rest of the day. Right now the market is deciding what it wants to do. Is it going to continue sideways in a narrow range like this, or is it going to have a 2 to 3 hour swing? All right, so the bulls did the minimum. So I think we're always in long. But again, we don't know if this is the start of a 2 to 3 hour weak rally up to resistance, or simply a leg in this trading range, and then it'll be followed by a leg down. Right now, I think it's slightly more likely that we're going up. The range so far is only 4.25 points, and you get a 4.25 point day only once every 2 or 3 years, and therefore today's still probably either going to break above the high of the day or they'll go below the low of the day. And right now, it's more likely we're going above the high of the day. For the bears, it's still a wedge, but 3 bull bars here, 2 bull bars here, several of the bars closing on or near their highs. I think most bears will not sell below 32, even if it closes on this low. Now, why would we be stalling right here? Part of the reason is a lot of bulls know the odds are we're going at least one tick above 15. And for bulls to take a profit at the 15 high, they have to buy 5 ticks below. And that means there are buyers 5 ticks below, which is right at the close of 31. You have bulls trying to buy there. Now, what about the trading range argument that we're near the top of the range? There's enough momentum, so I still think it's slightly more likely that we're going up above 15 than below 24. Remember, right now there's a 95% chance we've seen either the high or, 90% chance we've seen either the high or low of the day. And at this instant, which is more likely, at this instant, it's more likely that we've seen the low of the day. For the bears, a wedge, a lower high. Gap bars, you can argue that we're in a bear trend. We're getting lower highs and lower lows. Since here, we've been getting lower highs and we have a lower low here and then lower lows here, but we're at the bottom of the range, and the channel up is fairly tight, the wedge is fairly steep, 1, 2, 3. It makes it a low probability sell. However, if we go down, I will not be surprised. Trading range day, even though it's slightly more likely that we're going above the high of the day than it is that we're going below the low of the day, it's not 60%. It's better than 50-50, but it's not 60%. Okay, I'm going to put a big pink circle on every day Okay, today is the daily chart. Today's range is 4.25, and I have a pink circle now on every day where the range is 4.25 or less. Okay, this is the first one of this year. There were 0 in 2016. There were 0 in 2015. There were 2 in 2014. And maybe 1 in 2013. So in the past 5 years, there have been 3 days with a range of 4.25 or less. So, that's over 100 trading days. Excuse me, it's over 1,000 trading days, and only 3 have had a range as small as today's. Therefore, the odds are small that today's range is going to remain this size. The odds are high that we're either going to break through a new low or break to a new high. It's an okay swing sell. It's an okay swing buy. Usually when you have a very quiet range like this lasting a couple of hours, even though the day may get a little bit bigger, it usually does not get a lot bigger. So the odds are that even if we break to a new high or break to a new low, the 4-point range day might become a 6 or 7-point range day, but it's probably not going to become a much bigger day than that. How many bear bars do the bears need to make traders believe we're going to get the downside breakout? They need more than 1 bar. We may simply go sideways and form a triangle here. With a wedge, a lot of times you get 2 legs sideways to down, so we may go down a little bit more and bounce maybe around the 28 low. Moving average was resistance for 26 bars. Bulls are hoping that it's now support and that we keep channeling up, and it's just too early to know. I think it's still slightly more bullish than bearish, but if we get a 3rd consecutive bear bar, then I think it'll be slightly more bearish than bullish. Basically, 50-50 chance we break above the high of the day, 50-50 chance we break below the low of the day, and right now we're right in the middle of the day deciding which that will do. For the bulls, it's a reward equal to the risk. I think slightly more likely we go up. And for the bears, their risk up here, their reward down here. If we do go down, if we break below the low, we'll probably fall at least a couple points below. If we go above the high, we'll probably go at least a couple points above the high. And therefore, even though the risk for the bulls is here, the reward is actually greater than this. And for the bears, their risk is 1 tick above this, and their reward is actually bigger than that. So it's okay to be long with a stop below 1 or below 24. It's okay to be short, a stop above 15. For swing traders, most traders, the range is so small, it's probably better to be flat and just wait. This is the end of the third hour. You can see all three bars on the 60-minute chart have good size ranges, and the first two were decent trend bars. And the third bar so far has a tail on top. It's probably going to end up with a tail on top. There are only 30 seconds left, so it's unlikely to get to the high. But I still think slightly more bullish than bearish, but really pretty neutral. Sometimes you'll get a trading range for the first 3 hours, first 36 bars, and then a trend. I don't know if I have any examples of that. No, I guess like this. Trading range for 4 hours here, and then a bull breakout. And trading range here for about 3.5 hours, and then a bear breakout. That's not typical. You know, when you have a trading range for several hours, this is unusual to get a huge breakout. And this is unusual as well to get a huge breakout. Okay, the bears have had their 2 legs down, 33, 36. That would allow bulls to start buying, looking for a rally. The bears are hoping that this is a reversal, that it's a wedge, and that this is the first leg down, and they want a second, a third, a fourth, a fifth leg down. For the bulls, higher low, we have higher low 4, double bottom 24, higher low 28, higher low 35. I think we're still always in long, but I'm not particularly bullish. The bears are hoping that this is the first leg down, 34, and then we get an ABC pullback to a lower high, and then we get a second leg down. It's slightly more bullish than bearish, but not much. You know, I showed those days where there were big breakouts. You know, I think there were more trend bars on here, you know, 4 or 5 here and then 4 or 5 here. So I think there was a little bit more energy on this day than what we have today. Bears trying to get the breakout, and the bulls are hoping it's a second leg down and another higher low. Still 50-50, slightly, you know, maybe a little bit more bearish right now because we're getting the bear breakout, but it's still 50-50, whether we get a breakout to a new low or a breakout to a new high. 60-minute chart, you can see 3 sideways bars. Best choice, flat, and wait to see what the breakout looks like. Again, 2 legs down. So for the bulls, it's a high 2, a double bottom, but we're really neutral. We're exactly in the middle of a very tight trading range. The bears have a sell signal on the daily chart, and the bulls are at the bottom of a 5-day range. So it's pretty neutral. When can you start selling? I think it's better to sell either high or after the breakout. For the bulls, it's either better to buy somewhere down in this area. If the bulls get a reversal up, that's better, stop entry, or after a bull breakout. This looks like a give up bar, so it looks like bulls are giving up, but other bulls might buy around the low of the day, just above the low of the day. They're hoping for a wedge, 1, 2, 3. Can you buy above a bear bar like 24? I would not. I think if you're going to be buying with a stop, it's better to get a bull bar. And do the bears sell below 24 or below 1? Well, I think if they're going to be selling with a stop, it'll be below 1. And like I said, though, we could fall below 1 and then reverse up. On these days when the range is small like this and you get the breakout, the range usually becomes 2 or 3 points bigger, but I would say 50% of the time or 60% of the time it becomes 2 or 3 points bigger after the breakout. In other words, if it breaks below the low of the day, 60% of the time it'll fall 2 or 3 points from there. But 40% of the time it'll go below the low of 1 and then back above the high of the day. We're getting vacuumed down to support, and then we decide whether we're going to break below the support or reverse up again. On these small days, usually you get a breakout by the end of the 4th hour, which is right where we are now. Okay, here's a small day, and it stayed small all day. Here's a small day, and it was a 4-point range, and then at 11:45, that was the breakout, so a very small breakout. The next day, this is what the next day was. Next day was a huge day, even though this day was small. Another small day, got a little bit of a breakout, reversed up, broke again to the bottom, and reversed up again. You can see the bear breakout, immediately reversed up. So if you sell on a stop at the low, you immediately had to deal with the reversal. We broke out again. The total extent of the breakout was about 2 points. The range was 4.75, and here it became a total of 7 points. This is unusual where you get the huge breakout. These are more typical. It stays sideways, you get a little bit of a breakout. Here, a little bit of, this is probably the most similar of all the ones that I showed, where you get a little breakout. Maybe it reverses, maybe it goes down for 2 or 3 points, but probably not going to be very much of a move up or down. Now, what about the buy the close bulls on 31? Right, you can see 41, those bulls were disappointed by this. A lot of them placed orders to get out break even or with a 1-tick loss, and that's what 41 was. A lot of the bulls desperate to get out with a small loss or no loss, and they sold. And the remaining bulls gave up, some here and then others here. However, some bulls are holding, and if they bought here and are holding, they're looking to buy more above a bull bar, maybe above 47. In general, they would not buy above these bull bars because they want their second entry at least 2 or 3 points below their first. They want to be able to make a decent scalp on their second entry, and then they try to get out break even on their first. Because scale end bulls will buy above 47, if it looks like that when it closes, it's an okay buy. And for the bears, they're hoping that it's a pullback and that we then break down below the low of the day. I'm neutral. The location, always with the trading range day, when it's near the bottom, the momentum is good for the bears and the location is good for the bulls. When it's near the top, the momentum is good for the bulls and the location is good for the bears. The bears know that the probability of a bounce goes up if it trades above a bull bar 47, so the bears are trying to prevent it from going above 47, just like the bulls prevented it from going below 6. For the bears, it's a pullback from the break below this double bottom, and for the bulls, it's a double bottom or a triple bottom, a triangle. the volume looks small. Let me see what these bars look like. This bar has 2,000 contracts, 5,000, 7,000, not even 2,000 contracts there. So a lot of the volume is pretty quiet. For the bears, a breakout pullback short, but the bottom of a trading range day. This is the buy zone. If the bulls are lucky, they'll get a micro double bottom and a second entry buy. Second entry buy here, a third entry buy here. And for the bears, I'm not, if the breakout is big below the low, I might chase it down, but chances are it'll be something like this, one big bar and then buyers. We broke out, then buyers. Small chance it'll just start to sell off relentlessly. Here we had 4 decent bear bars and then 2 big bear bars. If we start to get this, then it's sell to close looking for a swing down, but we probably will not. More likely, it'll dip below and then up, dip below and then up. The opposite of this, break to the upside, pull back, break to the upside, pull back. That is more typical. But if we start to get a series of big bars, then the odds of a big move go up. Do you remember on the open I said that with the trading range day, the market often has a 1 hour move up or down, and then it tends to get swings that are 2 to 3 hours long. And the bears can argue that even though we have a double bottom, it's been trending down now for 30 bars. Bears trying to get a low 2 at the moving average, but at the bottom of a trading range day, a lot of traders do not want to sell this close to the support level. For the bears, a low 2, but near the bottom of a very small range day. And the bulls, you can argue it's already a second entry buy. They buy above 47. The bears tried to resume, and then it went above 48, but I think it's not a very good looking buy. Nothing is good looking on a day like this. What I would like is for there to be a breakout and a reversal. This kind of thing, breakout and then a reversal, for a scalp up. But again, a huge trend, unlikely. A wedge, 3 pushes up, 1, 2, 3, but a fairly tight channel. Again, middle of a trading range day. You have to be still neutral. And even when there is a breakout, the breakout will probably fail to go very far. Getting near the end of the week, and the bears are failing to get the bear breakout. And this is the obvious magnet back to the open of the week. At the trend line, theoretically you have buy the closed bulls 31, and they buy more above a bull bar 47, and they need to get 1 tick above the midpoint to avoid a loss. So some bulls have bought that close, bought more above a bull bar here, and it went above the midpoint. They could exit here with a loss on this buy and a profit on this buy, and the entire trade would be break even. And that's part of the reason for the sell-off here. The dominant feature of the day, I think, is the bar 1 bull trend bar reversing up from yesterday's low. So I still think it's slightly more bullish than bearish, but you have to be neutral. We're right exactly in the middle of a small range day. And the range still has a 95% chance of getting bigger. So 95% chance we're either going below 1 or above 15. It's a Friday, so weekly support and resistance are important, and the open of the week I think is the most important of price. I think we're going to have a hard time getting there. We have to get above the high of the day, and we have to get above the 60-minute moving average. We may try to get there, but right now I think we probably will not get there. That's a second entry short, so slightly higher probability than selling below 54, but you're still selling in the middle of a small range day. I don't know that it's worth it. Becoming more bullish, but trailing range day, whenever it's near the bottom, it looks bearish. Whenever it's near the top, it looks bullish. I'm still slightly more bullish than bearish. The bears have been trying for 4 hours to get the breakout, yet we still have magnets above, important magnets. And when there are magnets within range on a Friday in the final hour, they have a pretty good chance of pulling the market to them. We're 4 points away, 5 points away from the open of the week. As I said, I don't think we'll get there, but we have better than a 50-50 chance of getting, close to there. In the weekly chart, that would turn the bar from a bear bar near its low to a small bear bar, making it less bearish. And after 5 bars up like this, it's not particularly bearish regardless. The downside risk is not all that great. And bears have another lower high and a series of lower highs. Just like it's an okay swing buy above 47, it's an okay swing sell below 60. The bears got a second entry short below 56. Could not get above the 54 high, where I think a lot of the stops would be. And that makes 60 a sell signal. But middle of a tight trending range, in the middle of a tight trending range day, the probability for bulls and bears is bad. Probably not going to go all that far up or down. And when we do get the breakout, there's at least a 50% chance that it will quickly reverse and not get very far. When you have these very small days and you do get a breakout late in the day after 3, 4, 5 hours, usually the breakout is only a few bars and does not go very far. When you have a day like this, the odds are very high there's going to be a breakout. But the breakout is usually brief, 1 or 2 bars, and then it fails. And that makes it hard to trade it, because let's say you get a big bear breakout, the odds are it's going to reverse, and therefore you do not want to be selling the breakout unless you see a couple bars, consecutive bars closing on the lows. Opposite's true of the bull breakout. If we just see a bar suddenly break above the high of the day, chances are it'll fail, even if it's a big bar. And that makes it hard to trade it, because that even if we break above 15, we're probably not going to go more than a couple of points up. And by the time you decide to buy, the market's probably already just about a couple of points up, and it's not likely to go much higher. So unfortunately, the way to trade it is to buy when it's near the bottom, sell when it's near the top. This late in the day, I think you cannot do that, and you have to hope for a breakout or a reversal. Maybe get like that, big bear breakout and then a bull bar, 2 bull bars, just buy with the stop and hope to make a couple points. If you get a bull breakout, the same thing, you look for a reversal down. But the odds of the market trending very much at the end of the day are small. Is there still a 95% chance that we're going to break above the high or the low? I still think so, because a 4.25 range happens only once every few years, and to bet that today is the day is a low probability bet. Lots of days begin with a small range. However, very few days make it to 5 hours like this with a small range. And obviously the more hours that we stay small, the smaller the chance is that we will break out. But I still think, right now, 95% chance we're going to get a breakout. And I think it's slightly more likely that we'll get the upside breakout because we have the magnet at the open of the week. You sometimes hear me say that an II pattern is a triangle on a smaller time frame chart. You can see the 60-minute chart has an I, and so the current bar began at bar 61, and prior to bar 61, when the 60-minute chart was just an II, we had a triangle. And while it's not always the case, better than 95% chance, if you have an II pattern, you have a triangle on a smaller time frame chart. And this is an example. We have a triangle here, and that was while we had an II here, and then we added another inside bar here, and it's still a triangle. 60-minute chart, III, and we're breaking above the last hour's high. Bar 63 is the breakout, and we're trying to continue up. In the final hour, as I've been saying all day, if we're within 4 or 5 points of the open of the week with an hour to go, better than a 50-50 chance we'll try to get there. And we have an hour to go, and we're within 3 points of it. Bulls trying to continue up. Now it's a 4.5 point day. Still probably will get a little bit bigger. I doubt that we'll get above the open of the week. We might get there. For the bears, they want to sell a reversal down, but this is now a small pullback bull trend, and stop entry bears will not sell. Limit order bears I would not sell either, so either you're long or you're simply waiting for Monday, which is probably the best choice. Difficult to do anything. I think you cannot sell. It's technically by the close. We've now increased the range to about 5.25 points. It's still small, but and it probably will try to get bigger. However, this is late in a by the close rally, and we're at 2 resistance levels, the 60-minute moving average, and we're within a point of the magnet that I've been talking about all day, the open of the week, and therefore we're probably not going much higher. We might go a little bit above the open of the week, a tick or two, but I doubt that we'll go much more than that. I measure move up from the double bottom. We have a double bottom neckline just above the open of the week. A big bar, 75, late in a by the close market, usually climactic and not going to go much higher. The bears, I think they're not going to sell. And for the bulls, it's by the close, but they'll get out 4 ticks below a bull bar or 1 tick below a bear bar. You have to laugh, right? You see how quickly that moved? Remember I said the buy the close bulls would get out about 4 ticks below a bull bar, 77. And do you see how quickly it reversed down? It hit the open of the week, and within seconds, we put up a 5-second chart maybe. Okay, it's a 5-second chart. So within a matter of seconds, it fell about 2 points. Make it a 3-second chart. So it took about 10 seconds to fall on 3 points. Anyway, you can see how if you're not really quick, for example, if you're buying closes, every time you buy, you place a stop 4 ticks below the low of the most recent bar. And as soon as this bar closed, 77, you're going to put a stop 4 ticks below it. But you may not have had time. By the time you moved your stop from 4 ticks below this bar, that stop was probably hit. So you probably got filled down here. So you bought here, here, or here, and you got filled here. And you're saying, what happened? How did I lose money? It was a buy the close bull trend, and I lost money. And that's because risk happens fast. How much volume on 78? 71,000 contracts. So, and then so far this bar has 56,000 contracts. So even though we had several bars today with only 2,000 contracts, the computers are always there. And they're always looking for things. And, when I drew that green line in at the beginning of the day, you may have looked at it and said, oh, what the heck is he doing? What, that line, how can the market, nobody's going to pay attention to that. And now we're at the end of the day, and do you think the market paid attention to the open of the week? So do you think the open of the week matters? Do you think it matters to the computers whether or not the weekly chart ends with a bull body or a bear body? It clearly matters, right? If it closed 1 tick above the green line, this would have a bull body. If this week closes 1 tick below the green line, the open of the week, the weekly chart has a bear body. And when you see this big a reversal, that's as big as the entire range of the first 5 hours, and it occurred in 1 minute. So it's a relatively huge move, and it tells you that it matters to the computers whether or not this week on the weekly chart has a bull or a bear body. For me, it does not matter. It's a doji bar, and I talk about this all the time. It doesn't matter if there's a small bull body or a small bear body. The market's neutral, and breakout mode, it's a limit order market, so breakouts typically fail. And whether it has a small bull or a small bear body does not matter. It's a doji bar, and so it's a sell signal bar for a failed breakout above the August high, but it's a weak sell signal bar. And then this rally is very strong, and that makes it even relatively weaker. So whether it has a bull body or a bear body, it's still a sell signal bar going into next week, but a bad-looking sell signal bar, not likely to lead to a big reversal. And the context is bad. The past 4 weeks, 3 of the past 4 weeks were up very strongly. Monthly chart, 11 months without a pullback. Really, really unusual. I doubt that it's going to last another, 1, 2, or 3 months. I think, either next month trades below this month's low or December trades below the November low, and then we go sideways for a few months. And on the monthly chart, that might not seem like much, but the bars on the monthly chart are, 50 or 100 points tall. A lot of them are about 100 points tall. So if we go below the low of the prior month, at a minimum, we're probably correcting down about 100 points. Really quiet day today. I said on the open with bar 1, it was a possible low of the day. I said maybe 25% chance. And I said always in long, we probably would try to get to the moving average. which we did, and the bulls bought aggressively here, I think less aggressively here. These two bull bars are less impressive than this. And then today, even less impressive. The two bull bodies here are smaller than the two bull bodies here. So it looked like we were probably going to go sideways. Did I think we were going to go sideways for 6 hours in a 4-point range? Of course not. That's very unusual. But I thought we'd go mostly sideways. And then after a few hours, breakout mode, the odds, I kept saying 90% chance that we would get a breakout. And I thought a test of the open of the week was more likely than a downside breakout because we're at the bottom of the trading range. And if we were within about 4 or 5 points of the open of the week in the final hour, the market would try to get there, which is what happened. But that does not make it easy to trade. I took 1-point scalps all day today. I tried to swing a couple times, but changed my mind because the follow through was just bad, and it looked like the trading range was continuing. And I don't want to be short at the bottom of a range, and I don't want to be long at the top of a range. For stop entries, you could buy above 1, arguing a failed breakout below a channel. I thought we would need a second entry, like yesterday and the day before, and we got it on bar 7, and terrible entry bar, terrible follow through. So it looks like rather than a rally like we had the past 2 days, we're probably going to go sideways. The bulls made several attempts to rally, and then they stalled. For the shorting, if you're shorting at the moving average, I would short below a bear bar, below 15, and we stalled at the 4 low, and we got a double bottom with the 4 low over here in 24. And then if you're buying for a swing up, a break below the neckline, measure move up, I'd rather buy above the bull bar closing on its high, 26. And that failed here. We got a wedge, 1, 2, 3. I thought we would just get a little pullback and then trend resumption up. Instead, we got all the way down to the double bottom. And then to buy here, again, on these reversals, I prefer to buy above bull bars, so 47. Does that one also need a second entry buy? The channel down is fairly tight, small pullback, bear, 1 bar pullback, 1 bar pullback. It's better with a second entry buy, but the location is good. And then we enter into a small pullback bull trend for the rest of the day. And you could buy with stops or limit orders for a swing up to the open of the day, the open of the week. But I don't know that it's worth scalping, especially once the market's in the upper half of the range. Buy the close, sell the close. Well, 1 is probably buy the close, and 8 is buy the close, but it's bad. A small bar, big tail, just below the moving average. And is it always in short on 17 or 18? Well, it might be, but we're at the bottom of the range. So unless we break strongly below the range, I don't know that it's worth shorting down there. And then, maybe it's always in long on 27, but now you're already halfway up in the range. So it's really not a good buy the close, sell the close day. I talked about buy the close 75, but a big bar and at the 60-minute moving average and only 1.5 points below the target. And there's that chance of risk happening fast. And therefore, if you're buying that 75 close, you better have plans to manage the trade, and you got to be really fast. Limit orders. It was actually not a great limit order day. I would not sell above 1. I would not sell above 2. Buying above 3 made sense. And then up here, I would not buy below 11 because it's a wedge. We might be getting a wedge opening reversal down from the moving average. Maybe selling above 13. I don't think it's all that great. And then down here, we're at the bottom of a trading range. Buying below 20, buying below 19 makes sense. Buying below 27. And then up here, can you buy above any of these bull bars? You can, but I think minimum stop below 24. And then limit orders, probably buyers below 48, probably buyers below 54, 62. But, the probability risk reward might not be good enough for a scalp. Okay for a swing, for a test up to the open of the week. 1 bar left. Again, I don't think it matters what we do here. What matters is a doji bar, and that makes it a sell signal bar on the weekly chart, but a weak one, and the context is weak as well. What was the volume on 79? 66,000 contracts. So even though the day was extremely quiet, we got the breakout. And as I said, when you have these very small range days and they break out, usually the breakout does not get very far, and there's a high probability of some kind of a reversal. This was an unusually violent reversal, but that's the risk that you take when you take those buys. Take a look at questions. Question: you take sell limits? Do you take limit sell orders at the bottom of the range? For example, bar 19, we had 4 bear bars down, and first a bull bar up with a tail. Do you sell, SOC that bar or sell above it, or sell on the close of that bar or sell above it for a point down, or is that too risky at the bottom of the range? I sometimes will sell at the bottom of the range. Okay, if I see obvious support like the 4 low, and if I'm selling, I have to sell. So if I'm betting that we'll get down to support or to within a tick of it, that means, let's say I think it's going to get to the 4 low. That means for me to exit, I have to exit 1 tick above the 4 low, and that means I have to sell 4 ticks above that. So if I'm selling near the bottom of the range, I always have to sell at least 5 ticks above the support level, and selling above 18 is 4 ticks above the support level. Sometimes in a situation like that, instead of selling the 18 high, I'll sell 1 tick above it, because a lot of times you'll get a couple tick bounce. But if you do try to sell 1 tick above, sometimes you miss your trades. So in certain circumstances, in fact, I may have sold that, I don't remember, but in certain circumstances, I will do it, but I need the support to be at least 5 ticks below my entry price. Okay, Al, why do you scalp when you tell everyone else to swing? Just asking because you always suggest swing most of your trades. Do you find it more profitable for an experienced trader to scalp rather than swing? I believe that the more you trade, the more profit you can make scalping, right? Just think about it in terms of Warren Buffett. Okay, he's holding positions for years, and his average return is comparable to the average return of the stock market. I don't know what it is, but I'm guessing it's about 8% a year. And then you get hedge fund managers who are holding positions for a week, 3 weeks. They're trading, and their average return, a really good hedge fund might make 20%. And then, so in other words, they're taking more trades and they're making more percentage. And then you have fast money traders like the guys on Fast Money, and they're holding positions for 1 day, 3 days, 5 days, and their return is probably, I don't know, I'm guessing 50%, 100%, maybe more. And so in other words, the more entries you take, the more money you can make. However, it's also harder. For example, it would be impossible for Warren Buffett to trade a fund his size and at his age, in and out, 5 times a week. He just couldn't do it. And, so you have to be able to do it, and you have to be comfortable and happy doing it. I think, if you get really good reading price action, you're going to start to see more and more trades. And sometimes you'll hear me talk about that little guy holding his arm out with a small bag of gold, offering it to you. And do you take it? Or do you say, nah, it's too small. I want a big bag of gold. And, I'm still alert and fast enough to grab a lot of those bags of gold. So it's profitable and it's fun, and that's why I do it. But it takes a long, long time to get to that point. I don't know how many years, but it takes, I would guess 3 years, 5 years or more of trading to increase the number of trades. When you first start out trading, I talked the other day about one bullet in your gun. You just look for one trade a day, and as you get better, you might look for 2 or 3 trades a day. And if you get really good, and if you're happy to take 10 trades a day, you take 10 trades a day. But initially, at least for the first many years, I think it's really, it's hard. If I give you, I don't know, a piano and tell you to play chopsticks, you could probably learn how to do it inside of an hour. But if I tell you to play a piano concerto, it would take years to do it. And it's a comparable thing with trading. If I put a soccer ball in front of a net and tell you to kick it in the net, you can do it. But, for you to score a whole bunch of goals against a really good opponent, it'll take you years and years to do it. Trading is the same way. I think it's far easier to get profitable and consistently profitable if you begin by looking for 1 or 2 trades a day and just looking to swing. So, for example, you buy above 7, put a stop below 4 or below 2, and come back in an hour. You come back in an hour and say, oh my gosh, look where it is. I bought it up here and now it's down here, but it has not hit my stop, so I'll stay long. And is there clearly a good reason to get out? No, I stay long. And then, to the end of the day, you get out 4 ticks below the bull bar. And this particular day, you'd end up making a couple points, but that's what you do. You get long until there's a reason to not be long. Either your stop gets hit or there's a reasonable reversal, and that's what you do. And you say, well, gosh, I held on for 70 bars and I made 2 points. That's no good. Well, it's okay. So, I'm not opposed to anybody doing anything. I'm not opposed to a person taking 50 trades a day, no trades a day, 1 trade a week. I don't care. All I care about is 2 things. 1, are you making money? And if you're making money, then, you deserve everybody's respect and admiration. And 2, are you happy? And very few traders can happily scalp, right? A lot of people can scalp, but it makes them feel tense and miserable. And then, other people would love to scalp, but they just can't do it for a number of reasons. It's just, they're too slow to react, or they're too slow to make decisions, or they make too many mistakes placing their orders because they have to place things quickly. You have to have both. You have to be happy and profitable to do it. And, I would say, maybe 5% of profitable traders have that combination of happiness and profitability when scalping. So, 95% of good traders do not scalp. And the majority of really, really good traders, a lot of them just trade at home quietly, like me. But, a lot of them, if they're young, they start managing money and they, create a fund and, a hedge fund. And when they do, they end up trading less and less and less. Paul Tudor Jones is an example. Back in the 80s, he's probably about my age. I think he's probably in his 60s. Maybe he's a little bit older. When he started trading, he was aggressively trading, taking a lot of trades a day. And then he quickly went from managing like $5 million to $100 million, I think just in a matter of months. And now he's managing billions of dollars. And as his account grew, his fund grew, he had to trade less and less often. Because back in the 80s, if he had $100 million or more dollars traded, and sometimes he was taking positions in the E-mini, he would be needing to take, I don't know, trade 1,000 contracts. And, he just, back in the 80s, you could not trade 1,000 contracts. I once read an article, an interview with him, and he said that he kept having to break his position size into smaller and smaller pieces, like 300 contracts, 200 contracts, 100 contracts, because he kept getting bad fills. and now he's at the point where he manages billions of dollars, but he does not day trade. He like most hedge fund managers, when you start managing huge amount of monies, you cannot day trade. So I don't know if he holds positions for 3 days, a week, a month, years, probably all of that. But at some point, if you start to get really big, you can no longer scalp. But I keep coming back to the point that it's a lot easier to make money if you're swing trading, or at least going for 2 points, than it is to be going for 1 point scalps all day. I'm here watching the chart. I see stuff all day long. And so to me, I see these little guys holding little bags of gold out, and I grab them. But I think most people cannot do that, and most people would not enjoy doing that. And therefore, I think most people should simply look for 1 or 2 swing trades a day. And, some days they'll do really well. For example, if we have a huge bear day and we drop 40 points in one day in an extremely tight series of sell climaxes, a swing trader on that day will probably make more money than me if I'm scalping. Because, even if I'm scalping for 2 points, a lot of the breakouts will go 10 points and I'll make 2. And the swing trader who sold at the open, will make the full 40 points that day. And for me, it'd be very hard to make the full 40 points because if every low 1 or low 2 short, I exit at 2 points, yet the leg drops 10 points, I'm missing a lot of the leg. But on most days, a really good trader who has the ability to scalp and the ability to swing is going to make more money as a scalper. However, I think most traders shouldn't even consider it. I think, most traders who do swing trade will take occasional scalps. Hold on a second.
Muted.
Sorry about that. So I lost my train of thought on that, but I think that a trader has a much greater possibility of making money looking for 1 or 2 trades a day and trying for 4 points or more. And if you've done that for a year or 2 or 3 and you're starting to see scalps, you probably will take some scalps in addition to the swing trades. And a lot of traders see a whole bunch of scalps, and if the market is sideways like this, all they do is scalp all day. And, you can end up, there are not an incredible number of scalps today, but there were a reasonable number if you're really aggressive. You buy below 3, you buy above 7, you sell below 14, you buy above 26, maybe sell below 32, and then maybe either buy above 47, sell or buy below 48, buy below 54, and then in here, maybe buy a bull bar. And then, would I buy the closes? I'm not buying the closes up here. I said the resistance was 60-minute moving average in yesterday's high, so I would not buy up there. But anyway, if you're aggressive, there were a number of trades. Okay, question, what do you think about the hourly bond chart? As you know, I sometimes talk about the bond chart. Let me put up the bond chart on the daily chart. Let me get rid of that. That's that. Okay. I'll start with the monthly chart. As you know, I think the bonds they've made a major top, nested wedge, 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3, and a strong reversal down. I think this is the high in bonds for the next 20 or 30 years. So I think we're in a bear trend. We may go sideways for several years before we go down, but I think we're going down. We have a nested wedge top, first leg down, pull back, and probably a series of legs down over the next many, many years, next decade, couple decades. Head and shoulders top. A lot of times after a wedge top, you get a sell-off and then a pullback and the start of a second leg down, and it's also a head and shoulders top. Daily chart, less bearish. It's still a bull channel, and we're near the bottom of the bull channel. So arguably it's another buy. We sold off strongly here, yet rallied to a new high. We sold off strongly here. Maybe we'll go up to one more new high in the daily chart. I don't know. Hourly chart, as you know, it's been selling off. Let me do it this way. Okay. It's been selling off a lot over the past several weeks, but we're getting their support. Let me put up a 4-hour chart. Okay. Whenever the market's in a channel and it starts to get near prior higher lows, it's support. We have a spike pullback channel here. We're in that general area, and you can call it a wedge. 3 pushes down, 1, 2, 3. So we have a wedge bull flag and a bull trend. So it looks like we're probably going higher. Back to the 60-minute chart. And, it looks like we have a higher low, major trend reversal, double bottom, higher low. And looks like we're trying to test these lower highs. This is an obvious one. This is a strong enough rally, so some traders might think of it as buy the close, and they just look to buy more lower, expecting it to get back here. And we probably will. So I think, and then we've got a head and shoulders bottom here. So we'll probably get a measured move up to this area sometime in the next few weeks. I've been trading bonds, and when it's in a channel like this, I'm usually either buying at the prior low or placing a limit order to buy 16 ticks below the prior low, and then trying to scalp out when it gets back to around the prior low. Now we're in a bull channel. I'm currently flat, but I think it's always in long, and this is a wedge bull flag. 1 push down, 2 pushes down, 3 pushes down after a strong rally, and it's also a head and shoulders bottom. You can trade the TLT, which is an ETF that mirrors the 20-year treasury. Well, here's the 60-minute chart. And again, trying to form a head and shoulders bottom, left shoulder head, and then small right shoulder. And this is an obvious target, the most recent major lower high. So we'll probably go a little bit higher. But back to your question about bonds, I think that the hourly chart is always in long, and that we're probably going to try to get up to the major lower high over here. So, at least a point above where we are. Daily E-mini chart, we have this doji, but, we had a doji here, we had a doji here, sideways, doji here, sideways. Tried to reverse here, doji here, sideways. I think we probably are going to go a little bit more sideways before we turn down, but I think we're going to turn down. Here's the cash index. You can see, we got to around 25.10, 25.11, something like that. So a little bit above the big round number. And we have a spike pullback channel. The channel up has 1, 2, 3, 4, 5 legs up. Usually, if a channel has 3 or 4 or 5 legs, you get a bear break below the channel, and the entire bull channel becomes a bull leg in a trading range. So you start to get a leg down, and you look at it and you say, oh, this whole thing is a trading range. This is the bull leg, and then this is the bear leg. We have support at these major higher lows. So even if we come down here, we'll probably bounce and form a lower high, and then break down to the front of the leg down. That whole thing is going to take several months, which is consistent with what I've said on the monthly chart, that we'll probably get a pullback for 1, 2, or 3 months. And it's also consistent with what I've said about the weekly chart, that, let me go back to the E-mini weekly chart. Whenever you have a buy climax of any kind, this is, I don't have the 20-week moving average here, but you can see it on the weekly blog update that I'll do. Whenever you have an extreme buy climax, a minimum goal for me is 2 legs and 10 bars sideways to down. And 10 bars down is 2 to 3 months. So that's consistent with what I'm saying about the daily chart and what I'm saying about the monthly chart. So, but right now, there's no top. All right. I still think the ranges are going to pick up, and when we do sell off, if we sell off, I think we're going to sell off, but I'm short, right? And therefore I have to believe we're selling off before too long. I'm holding January puts and put spreads, so that gives me a lot of time. We may go a little bit higher, but I doubt that we're going a lot higher. And the reason why I'm holding way out in January is because the opposite of what Guy Adami says on Fast Money. He says that the market never gives you a long time to sell the top, and that's just totally nonsense. The market always gives you a lot of time to sell the top. Just scroll back over time and look at every major top. You had a whole bunch of time to sell a top. It usually does not give you much time to buy a bottom, but because the market's in a bull trend, it's been a bull trend forever. But tops, usually take a long time here, several months, and then, a big plunge down, right? So, look at this. Look at that big plunge. The market gave you a lot of time to sell the top, but not much time to buy the bottom. And that's the way bull trends work. They tend to drop and then reverse up sharply, and they take a long time to top out. And therefore, while we might have a top right now, more likely we're going to have to go sideways for 2, 3, 4 weeks before we build up enough selling pressure for the market to reverse down. Okay, hope everybody has a good weekend.